I've been trading markets since I was a kid, and between my college year and going to graduate school in the summer of August 1971, I was clerking on the floor of the New York Stock Exchange, and I followed markets. And on Sunday night, Paul Volcker and then President Nixon, really it was President Nixon, delivered the message that you're not going to get your money. Gold was money then, so we viewed things differently. You know, like money, fiat money, as we think about it today, was like checks in a checkbook so that you can go get your gold. And we looked at things through a gold lens. I walked on the floor of the stock exchange. I thought, this is a big crisis because you're not going to get your money. People not. And the stock market, I thought it was going to go down a lot. Stock market went up a lot. And I went and I studied history. That's, by the way, why I study history. So I studied history, and I found out the exact same thing happened in March 1933 with Roosevelt getting on the radio and doing the exact same thing. In other words, devaluing money. Okay. In other words, so when we're looking at the world now, we look at it through our currency lens. You know, we think things go up or down when we're measuring it in our currency. But in reality, the currency goes up and down. And so as we start to think about that, okay, think about what's happening. Yes, it's a currency. It's an alternative currency. It's not a fiat currency.
So do you think that it actually makes perfect sense that the stock market is hitting record high after record high at the same time that gold is hitting record high after record high?
Yes. Yes. It's very much like the early 70s. And then the question, because what do you put your money in? Okay. Of course, the stock market has, we can't speak about the stock market as a whole, of course, because the stock market is so bifurcated, you know, and the world stock markets are so bifurcated. But yes, that is the dynamic. It depreciates the value of money, and then it costs, because it's all about a storehold of wealth. What is your storehold of wealth? What's it going to be? A currency should be a medium of exchange and a storehold of wealth. But when you have so much debt, you know, that debt is money and money's debt. I mean, debt is money, meaning when you hold debt, you're holding a promise to receive money. And when I say money is debt, when you're holding money, you're putting it in a debt instrument. And so for those reasons, when you have such a supply of debt and debt instruments, and it's not an effective storehold of wealth, it's natural to go to an alternative storehold of wealth, which is why we're going to harder currencies. And, you know, and of course, gold is the most fundamental of those, not only because of the many years, but even there, it's, you know, as they say, it's the only asset that somebody can hold and that you don't have to depend on somebody else to pay you money for it. So in 1944, we had the breakdown of the monetary order. We had another breakdown in 1971, right? So 1945, we had the breakdown of the most countries' political orders and most countries' geopolitical order, right? So we have those cycles, which are part of then, you know, the overall greater cycle, are worth keeping in mind. So they look a lot alike to me. So when I look at it and I look at the 30s, I think there's a lot to be learned about that particular dynamic. So you could see those breakdowns. Okay, you have to then put them in the context, I think, of what the process is. What does a country do when it doesn't have enough money? Okay, there are a limited number of things. In order to see that, you can go back in history and get some understanding and also see what's going on now. So I think it's very, very similar to that.